Hello everyone, welcome to Crypto Basics Coach podcast. I'm Marco. I'm here to help people navigate this topic so as to benefit from the opportunity this new technology provides and not get distracted or put off from the nonsense there is out there about crypto. Anything and everything presented and discussed, whether here or in our sessions, is of an educational nature and should never be taken as financial advice. Always do your due diligence and consult professionals before making any final decisions. Hi folks, welcome back. Hope you've had a great week. What I wanted to talk about today in episode 11 is investor versus investing. Now, an investor definitely does do investing. However, someone who does investing isn't necessarily an investor. And that's something I want to get into over the next few minutes with you guys, just to challenge that thought process. So I'll give you an example. You'll have, I've encountered plenty of business people who are very good at what they do, and hence they develop discretionary income. And of course, they're looking to make that money work for them. They may have already reinvested in their business as much as they can, and so they're looking to do something outside of that. And a lot of business people also like to have some sort of control over what they're investing in. And a typical option is that they'll invest in property, usually residential property. It's something that they know, which is one of the reasons they invest in that asset class. They live in a home, and so they understand the concept of other people needing somewhere to live. They pay rent, you do your sums, your loan to value ratios, your interest payments, etc., etc. And a lot of accountants also promote in countries that have a negative gearing aspect to their tax laws, and they'll advise these sorts of people to invest in property. And so you'll often get business people with lots and lots of residential property. Depending how it's leveraged, often they may find themselves asset rich, cash flow poor, but they focus on that specifically because they understand it, or they feel they understand it, and they don't tend to venture outside their lane. And you can't blame them, usually because the reason they have successful businesses is because they spend most of their time, whether it's at work or not in the office, focusing on their business, working in the business, working on the business. And so it's pretty hard for them to be learning a whole bunch of things outside that. And so they'll pick one particular niche. And there are some business owners I know who are heavily involved in owning shares, again, because that's what they understand. So they're quite limited to one or two asset classes. The other example is a professional, let's say a doctor. Again, same situation. They've done a lot of studying. They're continuing to do a lot of studying. They're spending a lot of time in their practice. And again, they've got discretionary income, and they too potentially invest in residential property or perhaps shares. Again, usually just one asset class because, and especially in the case of a doctor, you would want them focusing on their skill sets, given the advice they give out, and hence they're not going to have a lot of time to be investigating financial markets, charts, maybe geopolitical issues that are going on around the financial world. Okay, so they stick with their lane pretty much as well. And what I've also found quite common in this situation is that both business people and these professionals, they have a heavy reliance on financial advisors. One of the reasons predominantly, as I've mentioned, is they don't have the time to investigate things themselves. And more also importantly is they do at least understand that perhaps they need to diversify, but they don't have the time to learn about the other aspects, the other industries, the other assets. And so they'll engage with a good financial advisor who perhaps can help them diversify their portfolio. Now, this is what I'm challenging, is that while these people are investing, I don't term them as investors. And I'm going to go on to explain why. Being an investor, a professional investor, or an investor that is investing full-time, they may be a family wealth manager looking after the family portfolio. They may be a trustee of a portfolio, or they may very well be just living off the returns. In other words, they don't have a job and they don't have a business. This type of person has skills that I think are glossed over and aren't respected enough, again, by the people who may be investing, but they're not investors. Okay, and I'm just going to go into some of those skill sets to help you understand the difference. And this isn't meant to, scare you from becoming an investor. It's just to clarify. This is what the whole channel is about. It's just to clarify factually what some of the truths are out there. And by all means, I absolutely encourage you guys to become investors, because you'll have a far better and balanced and in-depth understanding of how the world works financially, and you can make better choices with having more information. So let's have a look at some of these skills that these investors have. So one of the things, and by all means, this is on an exclusive list, but I'm hoping to cover most items. So the first one, understanding business or money cycles. You may hear of them being referred to as liquidity, the debt markets, or interest rates. Understanding how interest rates change the liquidity going into the market, understanding where that liquidity will go, and the opposite when interest rates are going up and the liquidity is being sucked out of the markets, what that does to certain business opportunities, certain asset class opportunities. So understanding the market cycles is quite important if you're going to become a professional investor, because you'll understand how each of the assets you may be invested in, each will be affected differently. And you can then act accordingly to not just minimize risk against possible loss, but also be able to exploit certain assets, as they're the ones that are probably going to receive the benefit. Okay, so as a very simple example, when interest rates go up, you'll see some money moving out of the more what they call risk-on classes like shares and crypto and so forth, and they might move into the US dollar or government treasuries. Okay, and so the money markets are doing quite well, and a lot of retirement funds are involved in that, and they do well when the interest rates are up. When the interest rates go down, you'll start to see a more risk-on attitude take place in the market. And again, if you're able to position a portion of your portfolio to take advantage of these shifts, well, clearly your portfolio is going to grow and you're going to get better returns over time. The other one is, of course, understanding some global geopolitical or having some geopolitical awareness. With what's going on in the Middle East, with what's going on in regulations and government changes in certain countries, Western countries, the BRICS countries, etc., where you might be, hearing about war starting, or war has escalated or is de-escalating, how these sorts of things also affect your asset class, whether it could be oil prices, for example, or oil supplies, and how that may create inflation for one economy, but it doesn't create inflation for another economy. And again, how does that affect your asset, your portfolio, and how you can then manage it from there. The other thing is they understand the strengths and weaknesses of certain asset classes, so that they're able to take advantage of the cycles. So in some instances, commercial property is far better to own than in residential property. If interest rates are going up, you might find that the residential property takes a bigger hit than commercial property. You might find that in that instance, gold or silver or precious metals might start to do better, because people are running to what they consider safe haven investments. Okay, so, and again with shares and crypto, all these asset classes have certain strengths and weaknesses. All of them do better in certain cycle periods or cycle phases than what in others. Okay, so it pays to know at least the basics of understanding how each asset class operates and works, or what can affect it, either in a positive or a negative fashion. Then also understanding the movement of funds between these asset classes, whether there's tax implications or how liquid you want to be able to take advantage. If anyone has tried to sell a piece of property, you know that it's quite a cumbersome asset. Expensive, cumbersome, involves a lot of movement, and sometimes it can take you months. So in that time frame, you may have already lost the opportunity that you were looking to go after. So what portion of your portfolio should you keep fairly liquid, so that you can quickly move funds from one opportunity to another? Okay, this is something that a professional investor understands and does well, and will always have a portion of their portfolio ready to take on, whether it's a major pullback or whether it's just a buying opportunity, or perhaps you may have an incented seller in a particular asset class that things have happened and they need to get rid of it, but you're not sitting there with enough cash, and so you can't take advantage of it. Another thing that the professional investor needs to understand, because it affects ultimate profits, is structures. Structures like companies, trusts, LLCs, which stands for a limited liability company. If you're dealing with offshore entities, you'll encounter LLCs and a bunch of other acronyms as well. And sometimes you also need to understand the share classes within a company's share structure. Some shares give you different privileges to other shares. Okay, so number one, if you're creating a company, you need to understand it. If you're investing in a company, you need to understand the class of share you're investing in. You may find yourself with the class that has no voting rights and perhaps is going to be treated last in some sort of liquidation or default. So you need to understand share classes within companies. And all of these things ultimately affect tax implications as well. Some structures are a little friendlier towards tax. Some structures may even have incentives from governments to minimise tax. As you may have heard on the news and in TV, sometimes major manufacturing companies will come into a country specifically because they've been given tax benefits. Okay, so sometimes it can actually be the location that's just as important as the structure. But again, professional investors know how to maximise their gains and minimise their risk by understanding, number one, the structure that they're investing through, i.e. where their money is coming from, and two, the structure that the investment is being made at the other end and what rights and privileges or just risks that you might be taking in the structure you're investing in. So understanding structures is very important. One of the other areas that professional investors, and look, I have to say this is probably less than 2% of the world's population will ever venture into this particular area, but that's jurisdiction. What do I mean by that? Well, you can have investments in Australia, you can have investments in Asia, you could have an investment in the US, you could have an investment in the UK. You could have an investment in a tax haven. Each one of those is a jurisdiction. Each one has different laws. They may be similar, but you still need to understand them. Some of them may give you access to investments that you wouldn't normally get where you happen to reside. So understanding, again, where you set up your structures to gain access to the investments and where these jurisdictions are for where you are actually investing, again, it's important. You shouldn't assume that all investing that you're going to do is going to be in your backyard. That's probably not a good diversification strategy. Okay, so you might think, okay, well, I'll go outside my state. Or, okay, well, what about going to a different country? A residential property could be advantageous in America, could also be advantageous in Europe. Okay, so don't necessarily bind yourself to where you live. You might be missing out on huge opportunities. And the reason that most people don't is through a lack of education. Hence, they determine it to be too risky because they don't know. You know that this channel is all about learning, so I encourage you to go off and learn. One of the other ones is they're very good at diversifying. As I spoke about before, they are able to move their money in and out of different asset classes at the right time, so they understand how to diversify, how much percentage to have in each asset class, perhaps also in which economies. Again, Asia has done particularly well over the last 5 years, a lot better than some of the Western countries. So you could have had some of your funds in that region doing quite well, or some of the Eastern European countries. Some of their economies have done particularly well as well. But again, if you don't have the information, you don't have the knowledge, you don't have the understanding, you're not going to venture into these areas. And they'll also understand a certain element around industries. You know, when is it time for manufacturing to be invested in? When is it time for perhaps resources to be invested in? When is it time for crypto to be invested in? Okay, or just IT in general, technology. So again, these professional investors have got a good understanding of how to diversify across multiple assets, multiple industries, and potentially even multiple economies, even to the degree of multiple currencies. Okay, I'm sure that most of the people I'm talking to here, wherever you are in the world, I imagine that you would probably have 100% of everything you own in your own currency. You're probably not even holding an alternate currency. But in other more unfortunate parts of the world, I can assure you that they'll probably be holding on to US dollars because they see that as the cleanest shirt in the cupboard, as they call it, because it's quite a strong currency, far stronger than the one that they have, like in Argentina or Venezuela, for example. Okay? Now, this isn't an attitude that if you come from a comfy Western world country like Australia or Canada or America or the UK, you probably wouldn't be thinking about holding another country's currency. But trust me, look into it and understand how you could potentially take advantage of just currency exchange rates to be making money. Or there might be opportunities in a certain country that you want to take advantage of rather than converting it at a time where you won't get a great conversion. If you've already got that currency, well, guess what? You can take advantage of that opportunity. Risk management goes without say. They understand everything I've previously mentioned, usually not just for the idea of, well, how can I make more money? But more often than not, to the people I've spoken to, the main reason that they have educated themselves and understand a lot of what I've already mentioned is so that they're able to determine what the risk is, and that they're then able to determine, well, what risk management strategies can I implement to minimize and manage that risk. Okay? Nothing is riskless. Nothing. Even crossing the road, okay, is not riskless. So it's all about understanding how do you manage risk. And understanding some of the things that I've just mentioned will help you navigate those waters to minimize your risk and maximize your gain. Another skill set that I'd recommend that I know a lot of these people will at least refer to, even if they don't spend hours and hours and hours in front of these things, are charts. Having a basic understanding of how to read a chart, a little bit of charting analysis, even if someone is giving you their analysis and you're able to follow it, that's a huge benefit. I'm not suggesting that you become a full-time trader and that you're going to spend 10 hours a day in front of the charts. What I am saying, though, is that sometimes to give you some backing evidence to your decisions, that by jumping on some charts and having a look, even from a timing perspective, sometimes even from a sanity check where, you turn on the news, you listen to X and you go, oh my Lord, what just happened? You jump into the charts, have a look, draw back to a higher time frame, and you might find that, okay, this is just a little glitch. But sometimes when you're living in the moment, when you're looking at those shorter time frames, you potentially freak out thinking, oh my God, should I act here? Should I act? Often it's a case of, no. Just, it's the market makers doing what they do, playing their goddamn games. Just sit tight. You've invested in the right investment, and the charts can help you get a sense of confidence to do that. Some of the other things is financial and economical language. Just like with any industry, and as I've mentioned before, I come from the IT industry. I don't think any industry has more acronyms than the IT industry. But guess what? The financial industry is just the same. So is the economical. They have all these wonderful words that when you look into them, seriously, someone could have just picked simpler words to define something, but it is what it is. So IT, financial and economical language can be a real pain. But again, if you need to understand what people are saying, what people are trying to convey, you're going to need to learn some of those languaging terms, understand when they're appropriate, understand what they mean. And that's just something that you'll learn over time. I'm not suggesting you go off and do some degree or, some course. By all means, you can do a basic economics course, but you'll eventually run into all these terms. And what I've actually found over time is that if you give it long enough, most terms end up being defined for you. If it means a lot to you, then just ask the question. Okay. I know a lot of people say there's no such thing as a silly question, but still a lot of people do hold back because they don't want to appear silly or appear uneducated. But hey, this is about your financial future. Don't worry about what someone else thinks. If there's something you don't understand, ask. That's on you. That's not on them. Okay? That's on you. One of the other things that professional investors will understand is the difference between retail versus wholesale opportunities. And a lot of this can be defined usually in the Western countries. If you go for a retail product through a financial advisor, you're getting a prospectus, full disclosure, et cetera, it's well branded, it's probably got one of the major banks behind it, blah, blah, blah. And because of all of that, you're also going to probably get the least amount of return. Okay, this is the equivalent of buying a brand new house that's already been built, landscaped, fully furnished, fully invested. It is at the highest price it could ever possibly be. There is no margin. You're buying it at the absolute most expensive price. Okay, a wholesale opportunity is whereby perhaps there's an empty block of land and you decide to build on it. Okay, and you've already started to build equity into that investment. Well, those opportunities are not just in real estate. They also appear in the shares market. For example, if you can get a wholesale opportunity, usually you need to be accredited or sophisticated. You can look up those terms yourself. It depends on the region you live in. But it basically means that you don't need as much disclosure. You may get offered initial initial public offerings, pre-IPOs, meaning companies that are going to go onto the stock market, and you're able to pick up the shares at a 50, 60% discount before they're then made available to who? The retail investors. Okay, so no different than you can actually work a property deal to be able to build up more equity in it. You can also do that in the financial markets or in the shares markets by knowing the right people, getting involved in the right products. But typically in the financial industry, you do need to be sophisticated accredited to be able to get access to those. And just for those who you are listening, and look, this varies around the world, but this is just an average rather than getting into specifics. Typically, you're going to need $1 to $2 million of hard assets, not including the property you live in. Typically, you're going to have to be earning for the previous 2 to 3 years around $250,000 per year that your accountant needs to sign off on. Or the third one is, of course, if you're a financial advisor, you meet that criteria. Or fourthly, if you're able to invest a certain minimum, sometimes it might be a $500,000 or a $5 million minimum investment. Okay, that automatically qualifies you for sophisticated accredited. So, don't take that as gospel in your area. Go and check with your appropriate professional advisors, or just, go get Grok to give you an answer for the region you live in, what classifies as sophisticated or accredited. Point is, those people have access to a different quality of investment, which typically produces better returns. Yes, may have slightly higher risk, but that goes back to everything I've just said about risk management. Okay, but the point is, as long as you stay at that retail level, you are only ever going to get retail offerings and retail returns. Okay, so that's up to you. That could be one of your goals. That as far as your investment journey is going to be, how do I get to that wholesale status? And not to put too light a point on this, what's going to happen with crypto, and what is happening with crypto, is going to find a lot of people finding themselves in that wholesale, sophisticated, accredited classification pretty quickly. Okay, and to my point, that's why you're going to have more opportunities to invest in. That's why I'm encouraging you to learn about some of the things that I've just discussed, because with more opportunities, more decisions, more risk, more opportunity to make more money, yes, but you need to know what you're doing, or you might find yourself losing a whole bunch of wealth that you've just recently made. Okay, so this is what I wanted to get into today. I just wanted to lay that out there, put it out there for discussion. It may have upset a couple of people, but that's the way I classify things, okay? Professional investors have a set of skills that are far beyond just someone with discretionary income who happens to be investing, okay? And I felt it was important enough to clarify that, because if you are heading down the journey of becoming financially independent, if you are going down the journey of potentially trying to get rid of your job and doing really well with crypto and so forth, well, things that I've just mentioned, over time, don't panic, don't be overawed by all this, but in time you will learn all these things, but at least it gives you a starting point and a few markers on that road of the sort of things that you want to be looking into. These are things that I've learned because of my background. I've learned all of this myself. I didn't have anyone sitting down with me when I was 18, 25, 35 or 45 and taking me through this, okay? I'm teaching it to my kids. God bless them. Hopefully you've found some of this information beneficial as well. So last week's homework was supposed to be, well, go off and have a look at these spreads and slippage and understand how they affect your transaction. If you have, you'll realize that, yeah, wow, just because one platform says they only charge a 1% fee, once you've done your numbers, you might find that, yeah, but their spreads are so large that maybe I need to go to a different platform. So hopefully that's educated you on where to do your transactions. And sometimes that changes. Sometimes one platform benefits the other, and that can change in a matter of weeks or months. This week's homework is potentially going to shock you when you find out the truth. But what is the difference between bailouts versus bail-ins? And this is to do with the 2008 banking crisis, where the government, using our tax dollars, went off and rescued all the banks because, they did such a phenomenal job in lending money out that they deserved to be, rescued. And the amount of money that then subsequently went to paying management bonuses was quite disgusting in my opinion, but it is what it is. But they were bailouts. Bailouts is where the government steps in and through our tax dollars bails out these companies that should have gone insolvent if it served them right. However, look into what bail-ins are, and you'll probably roll your eyes in being just totally unbelievable. And subtly around the world, some laws have been changed as to allow bail-ins if the banking industry gets into trouble again. So enjoy that. Get Grok to maybe give you a summary of the differences between the two, and act accordingly. Until next week, stay safe, enjoy, keep your head down around crypto. There's some wild times ahead, and I look forward to talking to you again in a week's time. Take care. Bye. If you found this information helpful and are interested in a more hand-holding approach while navigating this complex industry, please visit cryptobasicscoach.com, that's basics with an S, and book a session. The first 30-minute session is free, and we can get to know each other, talk about what your aims are, what you're looking to do, and how I might be able to possibly help. I've helped people get started, set up exchange accounts, wallets, DeFi platforms, and general knowledge. Look forward to speaking with you. Cheers.